Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Verdon in London, and these are the stories that set your agenda. Mag 7 momentum. Nasdaq futures gain on bumper beats from Meta and Microsoft. But US copper collapses as President Trump exempts refined products from tariffs, sending it to its biggest ever intraday drop. And more buybacks for banks. SocGen and Standard Chartered both return more cash to shareholders. We'll speak exclusively to CEO Bill Winters. Plus, double dissent at the Fed. Rates on hold, but 2 committee members voting for a cut. Traders pair bets on a reduction in September. Well, it is a busy day of earnings here in Europe. We're going to get to the Fed and the Bank of Japan in just a moment, but we're going to work through these results for you throughout the programme, starting with breaking lines from Crédit Agricole. Net income in the second quarter coming in at €2.39 billion, a beat on the estimate of €2 billion. Of course, this is the first quarter with the new CEO, Olivier Gavalda. The banks in general have been caught up in the global market volatility. And we're going to be hearing from the Deputy General Manager and CFO of Crédit Agricole, Clotilde Langevin, later in the programme. You're looking at revenue at €7.01 billion, just a slight beat on the estimate of €7 billion. And they're looking at French retail banking coming in at €208 million. That's a 5.5% drop year on year. So we'll look forward to that interview. I'm interested to hear her views on that 15% US tariff on most EU exports as we start to see French companies hit. Speaking of which, we stay in France and we turn over to Renault. Those results dropping as well. They are seeing margins shrinking, highlighting the challenges facing the new CEO. Of course, these results, the first set of numbers since Luca de Meo's departure as CEO. The man credited, of course, with bringing Renault back from hell. His replacement announced yesterday, the company veteran François Provost. So in these numbers, we are looking to see whether the improved performance under de Meo is already over or whether the company's really in a better place. And what you're seeing is the revenue for the first half coming in at €27.64 billion. The estimate had been for €27.54 billion, so an ever so slight miss there. The first half net loss €11.19 billion. The estimated loss was €10.92 billion, so not as bad as predicted there. So that is the results in from Renault. We'll see how the stock fares when it opens. Both a read on the company's results, but also the board's choice of the continuity candidate in Provost. Now, we stay with transport, but go from cars to planes, and we switch over to Lufthansa. So they're coming in with second quarter adjusted EBIT at €871 million. The estimate was for €801.4 million. So a beat there. We're looking for evidence of progress in its turnaround plan, the impact of tariffs as well, maybe a bit of traveller anxiety over the US border security, how that has been impacting transatlantic demand, but they have confirmed their guidance after earnings beat estimates. So reiterating its full year targets driven by this continued strong demand on the transatlantic routes and lower oil prices as well. Can't forget that. The weak German economy seeming not to hit Deutsche Lufthansa too hard. Now, finally, we're going to switch to AB InBev out of Brussels. Of course, the world's biggest brewer, the maker of Budweiser. They've come in with second quarter organic volume growth of a drop of 1.9%. The estimate was for growth of 0.05%. So disappointment coming in from AB InBev there. Adjusted EBITDA margins for the second quarter at 35.3%. The estimate was for 35.4%. So an ever so slight miss when it comes to that. You've seen 8 straight quarters of volumes declines there from AB InBev. Analysts were expecting some early signs of recovery, but not so, it would seem, as first look at this company. So those are the earnings that we've got so far. We'll turn back to them shortly, but let's just take a broader look at these markets, shall we? We've got futures pointing higher on both sides of the Atlantic, powered perhaps by those mega-cap tech earnings yesterday. Meta and Microsoft beating expectations. Now we look ahead to Apple and Amazon later on today. So S&P E-mini futures up 1%, Nasdaq futures more so, and here in Europe we are in the green as we head towards the start of the cash trade as well. Flipping over to the cross-asset picture, you had seen the dollar jumping after the Fed held rates, paring those gains a bit now, and you've got euro-dollar currently at a 114 handle, so up 0.3%. Really, bond traders were unnerved by the lack of a sign of a September cut from Chair Powell. Treasuries were in retreat, the biggest retreat in 2 weeks, and you're looking at the 10-year yield currently at 4.35%, so down 2 basis points there. And we've got to talk about copper. President Trump exempting the most widely traded forms of the metal from his tariffs, so basically erasing the reason for the New York premium. So you're looking at the red metal down significantly in New York, trading 20% down, collapsing really, in contrast to London, though we have pared those gains a bit now. But let's turn now to Asia. The Bank of Japan holding rates, lifting the inflation outlook, and Avril Hong's in Singapore for us with an update on the market reaction. Hey, Avril.
Yeah, there is a lot happening in Asia, Lizzie, and there's no shortage of drivers today. Let's start with what we're seeing out of China, because we're still waiting out for that US-China trade détente extension, but already worrying signs in the data with Chinese factory activity worsening unexpectedly to a 3-month low, signs of export slowing. And then along with that, we had the top decision-making body, the Politburo, readout, disappointing those that have been hoping for signs of stimulus. So that is why the Hang Seng is leading declines in the region today. We're also seeing that underperformance in India's stock markets. Trump says they're going to be hit with 25%. South Korea getting a pretty good outcome with 15% levies, which is similar to what we got for Japan, but I will explain why we're still seeing that decline in South Korea stocks. Japan today is a bit of an outlier. Let's flip the board and take a closer look at the BOJ considerations, because as you said, it left rates unchanged. It raised its inflation outlook. That seems to be what investors are really focusing on, because now it seems like September rate hike, that could really be on the table. And we are seeing that helping dollar yen to move away from the danger zone of that 150 handle. Some pressure as well on JGBs on the 10-year. Now flip the board again, as promised. When you look at South Korea stocks today, the drag is coming from Samsung Electronics because its earnings miss, and we saw the chip profits tumble. So this is dashing investor hopes that that segment for Samsung's business was showing signs of bottoming out, that potentially high bandwidth memory area, which is of course crucial for AI, that finally maybe was showing signs that it could retake that position from its rival SK Hynix. So this is why you're seeing the moves in Asia at the moment.
OK, Avril Hong, we thank you for that update. I just want to stay in Asia and turn to China. Avril, talking about chips, we have a breaking news headline from Nvidia. China summoning Nvidia over the security risks of its H20 chips. This is according to a statement from the Cyberspace Administration of China that it has just put out. Of course, these advanced chips very much in focus when it comes to the trade talks between the US and China. These most advanced chips, not necessarily in the original position what the US had wanted China to get its hands on. So China citing the security risks over these particular chips. We await more details. But let's stay with tech. Of course, as Avril said, US tech earnings helping to power Asian equities higher in the session. And this is after Microsoft and Meta both have surged in late trading after the tech giants posted better than expected quarterly results. Both companies promising to spend aggressively in the AI race. And joining us now for more is Bloomberg's conglomerates, consumer and gaming reporter, Shirley Zhao. Thanks so much for joining us, Shirley. Just talk us through what contributed to Microsoft's good performance in Q2.
So Microsoft's performance in the second quarter really suggests that its heavy investment in AI development over the past few years is starting to pay off. So its Azure division, which provides computing, power, data storage, and AI services, is among one of the mostly closely watched divisions under Microsoft among investors. And this division in the second quarter performed very well and beat estimates because of increasing demand in AI. And its chatbot, Copilot, has signed up for over 100 million monthly active users. And that compares to Google's Gemini's about 450 million and ChatGPT's 500 million. So Microsoft is still stepping up its investment in AI and hoping to stay ahead in the AI race.
So it looks like all that capex is paying off. What about Meta?
So Meta's performance was also boosted by AI, and its money printing business is advertising. And this business performed very well in the second quarter and also beat analyst estimates. And according to its management, its application of AI on advertising really boosted revenue because they are able to charge higher price for ads. So for Meta and for a lot of other major tech giants, investing more and more in AI is one of their necessary investments going forward.
And just take us through the results from Apple and Amazon that we're expecting later on today. How much are tariffs likely to weigh on both of them?
So tariffs would really be one of the uncertainties facing these companies. For Apple, even though the second quarter is traditionally slower because of a lack of release of new phones, there could be a temporary boost in orders because buyers wanted to buy ahead of when Trump's tariffs came into effect. But how long would that effect last? We don't know, and this is one of the uncertainties facing the company, and investors are really seeking for answers on this because of the negotiations are dragging on over the tariffs. And for Amazon, it relies on Chinese suppliers for a lot of the things that it sells. So the dragging on of the tariffs negotiation is really creating a lot of pressure and uncertainties on its businesses. So I think investors will be focusing on the tariffs' impact on these companies and are seeking for more answers and perhaps more certainty for the second half of the year.
OK, Bloomberg Shirley Zhaoui, thank you so much for that preview of those earnings coming out later on today. Now, to more breaking news, this time from Luxembourg, ArcelorMittal, of course, the steel maker. It's cutting its 2025 steel outlook for the world apart from China. It has forecast that to decline slightly this year to a range within -2% to 0%. This, of course, with the backdrop of tariffs. So we continue to monitor that as well. But let's get back to the central banking story. Of course, we had that Fed decision last night. Fed Chair Jerome Powell saying that rates are in the right place to manage the risks around tariffs and inflation, so tempering expectations for a US rate cut in September. Notably, we had two dissenters, Governors Christopher Waller and Michelle Bowman, voting against the FOMC's decision to hold rates. And in his news conference, Powell leaning into the view that the Fed is well positioned for now.
If you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market.
Let's bring in Bloomberg's Valerie Teitel for more now. Val, we had all that pressure from Donald Trump to cut. It came to nothing. How hawkishly did the market perceive this press conference?
Well, it was those comments that you just heard from Fed Chair Powell about characterizing the labor market still as solid, and with inflation risk still on the horizon, we like where monetary policy is. We think it's appropriate. That really led to front-end yields jumping in yesterday during his press conference. They rose around 7 basis points. We're now putting that Fed rate cut in the second half of the year in doubt. We're no longer pricing a full rate cut when it comes to the October meeting, and the odds for the September meeting, that's their next one, have fallen from 65% of a cut all the way down to 45%. So really, it was this hawkish press conference that had the market rethinking whether we are pricing these interest rate reductions through the remainder of the year in a correct way. It also helped boost the dollar, Lizzie, and this is an important one. The dollar almost had its best session of the year yesterday, rising some 0.8%, and it's now on a 7-day winning streak for the Bloomberg Dollar Spot Index, rising nearly 2% in that time frame. Lizzie, this is a decent one here because if we do have a hawkish Fed, if we have a Fed on hold for longer than we expect, that's really something that can turn around the dollar weakness that captured so much of our attention in the first half of the year. There was 2 dissenting votes in this decision, notably 2 governors dissenting, something we've not seen for over 30 years, to have 2 governors dissent. One of them was Chris Waller. He very much telegraphed that before the blackout period, probably taking offense to the fact that the rest of the committee wanted to characterize the labor market as solid. He had said previously that he sees the labor market as flashing red. He thinks it's on edge. So he wants to cut rates to protect the labor market. He was also joined by Mickey Bowman in that dissent, with Chair Powell saying yesterday he expects to have their dissenting opinions out in the next few days for the market to take a look.
Only 3 more cut rate meetings to go, Val, till the end of the year. When are we going to get Waller and Bowman's influence taking over this committee, seeing a cut finally? Bloomberg's Valerie Titel, we thank you for that analysis of that Fed meeting. And we're going to get back to earnings next. Renault's operating margin falling to 6% in the first 6 months as the company appoints a new CEO to lead its turnaround. We'll bring you all the details next. Plus, later in the show, as Standard Chartered reports a beat on second quarter profit, we'll have an exclusive interview with CEO Bill Winters. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Renault first half earnings have declined as the French automaker appointed a company veteran as its new CEO. Bloomberg's transport reporter Danny Lee joins us now from Hong Kong for more. Danny, just walk us through the top lines from these earnings. How much were tariffs an issue this time?
Well, we haven't heard too much about tariffs this time, but indeed this is the first set of results for Renault without CEO Luc de Meo after a long period of time. But indeed, it is a set of results which he is still accountable for before he left for Gucci parent Kering. And it's a set of results which there was a miss on various estimates, particularly the operating margin value. That came in at 1.65 billion euro versus estimates for 1.81 billion euro. We also saw the net loss wider at 11.19 billion euro. As well. And the all-important operating margin fell in the first half to 6% from 8%. And when you look closer at the guidance for the kind of signal for the second half, Renault is still a bit more confident about the second half outlook, particularly as it's still reaffirmed its operating guidance for the full year of 6.5%. So that has been left unchanged compared to when it cut that back unexpectedly around a couple of months ago.
So that's the state of the company that Francois Provost, the new CEO, is going to inherit. I say new, Danny, but he's a company veteran. Why have they picked him in a turnaround? Why not pick some fresh blood like the Dacia boss?
Yeah, I mean, Francois Provost, the transformation chief, confirming a Bloomberg scoop that he was appointed on Wednesday evening and obviously replacing Luc de Meo. But he is someone that Renault thinks, as an insider, as a veteran of 23 years, can offer the stability that it needs at a time where it's still going through this transformation process. Someone who's worked across the company in various key businesses, from Russia to China, parts of Europe, taking on many leadership roles as he's been elevated. He's also someone who's stayed very closer to Luc de Meo, indeed a protege. And so it is important that someone like Provost, who has helped ink a lot of partnerships that has helped elevate Renault over the recent past, that plus his French civil service experience and the connections he's made will also help him, and that's why he was picked as CEO, frankly. But the challenges, though, are going to be how he's going to navigate this Nissan partnership, which is kind of tearing itself at the seams. We've also got these executive departures, key talent leaving, which is also going to be a concern, and also how to revive parts of the business, such as the struggling EV and software business Ampere. So there's still a lot on the plate for new CEO Francois Provost, and it remains to be seen what quite he will do, whether he follow in the footsteps of De Maio or try to find his own path.
All right, we'll see what the market makes of that continuity candidate. Bloomberg's transport reporter Danny Lee, we thank you for that analysis. Coming up, we're going to stay in France but switch gears to the banks. SocGen and Crédit Agricole both reporting earnings beats. We'll bring you the numbers next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Société Générale has increased the amount of money that it wants to return to investors and improved its profitability guidance as the French bank's turnaround plan gathers steam. Let's talk to Claudia Cohen, our French finance reporter out of Paris, for more. Claudia, let's start with SocGen, handing back more money to shareholders, €1 billion buyback. Does that mean that the turnaround plan is working here?
Yeah, it does mean definitely. I would say the second quarter that the CEO of Société Générale, Slawomir Krupa, who was appointed 2 years ago, it's the second quarter this year that really proves that the turnaround plan is working. The focus for the last 2 years was to straighten capital position, to have a CET1 ratio comparable as good to European peers. It's the case now. Then they focus also on streamlining the business. They sold a lot of assets, including, for example, last month they did sell another unit in Africa. So now this is over for SocGen. The CFO yesterday evening was saying that most of the business unit that could be sold have been sold now. So and now it's really time to return to investors. So as you mentioned, there is this new fresh buyback programs that investors were secretly dreaming about, and then also SocGen introduced a new interim dividends because this quarter it was able to beat on almost all the metrics, the estimates, the net income, the revenue, everything is a good story today for SocGen results.
And meanwhile, Crédit Agricole also exceeding expectations on profit under its new CEO. Why? What's going so well for them?
So for them, I would say it's another story. So as you mentioned, it's the first quarter for the new Crédit Agricole CEO, Olivier Gavalda. So they beat way more on net profits, but it's part of it, like a big chunk of it, is because of accounting adjustments linked to their asset management unit, Amundi. But without the accounting adjustment, it's still a bit. So I think the main point for Crédit Agricole, how they're really focused on the loan market in the home country in France. So domestic gross loan was positive, and it's what investors were looking at actually. And all the other units were quite positive, except if we can talk about their large customer unit, which is the name under the advisory unit. It was slightly down expectation, but still better than last year. Yeah.
All right, Bloomberg's French finance reporter Claudia Cohen, we thank you for that run through the French banking results. We're going to continue the conversation later on. The opening trade has an exclusive interview with the Deputy General Manager of Crédit Agricole. That's at 7:30 a.m. London time. But right here on Daybreak Europe, coming up, we're going to stay with banks. Standard Chartered announcing a fresh $1.3 billion share buyback after reporting a second quarter earnings beat. And we're going to be joined by the bank's CEO, Bill Winters. That exclusive conversation coming up here on Daybreak Europe as we're looking at futures pointing higher on both sides of the Atlantic, except for FTSE 100 futures flat to the downside. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Mag 7 momentum. Nasdaq futures gaining on bumper beats from Meta and Microsoft. But US copper collapsing as President Trump exempts refined products from tariffs, sending it to its biggest ever intraday drop. Elsewhere, more buybacks for the banks. SocGen and Standard Chartered both returning more cash to shareholders. We'll speak exclusively to CEO Bill Winters. Plus, double dissent at the Fed. Rates on hold, but 2 committee members voting for a cut. Traders pair bets on a reduction in September. Well, let's get to these breaking earnings out of BMW. The autos theme continuing in our second half of Daybreak. Top numbers as follows. You're looking at second quarter automotive EBIT margins coming in at 5.4%. The estimate was for 5.06%, so a beat there. It was expected to be more resilient to tariffs than its German peers. The focus as well on Chinese demand and how well it's going to recover in the second half. But BMW confirming its 2025 outlook. So we'll see how those shares perform at the open. But let's check in on our broader markets now. We had yesterday's tech earnings powering futures higher. That was Meta and Microsoft, of course. Now we look ahead to Apple and Amazon. But you've got Eurostoxx 50 futures up 0.2%. The FTSE 100 futures flat to the downside. But look at those Nasdaq futures surging up 1.3%. Now let's flip over to the cross-asset picture, because you had seen the dollar jumping after that Fed decision to hold rates. Pairing those gains somewhat now, and euro-dollar up 0.3% at a 114 handle. You'd seen bond traders pretty unnerved by the lack of signal on a September cut. So Treasuries had been in retreat, the biggest retreat in 2 weeks, but the 10-year yield now at 4.35%. And we've got to talk about copper as well. President Trump exempting the most widely traded forms of the metal from his tariffs. So really basically erasing the reason for the New York premium. So you're looking at copper in the red on both sides of the Atlantic, but a whopping great drop stateside, down 20%, more than as things stand. But let's get back to earnings now. Standard Chartered announcing a fresh $1.3 billion share buyback. The bank reporting second quarter earnings that beat expectations amid the tumult caused by President Trump's tariff war. Joining me now for an exclusive conversation, I'm pleased to say, is Bill Winters, CEO of Standard Chartered. Welcome back, Bill.
Nice to be here, Lily.
You've got better than expected results here. It looks like you've benefited from the volatility around Trumponomics. A lot of banks have. Do you think that you can continue this performance in the second half of the year then?
Yeah, I'm really happy with the results in the first half of this year, in the second quarter, including since April 2nd. It's really been building on 5, 6, 7 years of continuous investment in a few things. We're a cross-border bank. Every part of our cross-border business is booming. We are a bank to the affluent across Asia, Middle East, and Africa. That business is booming. So all the leading indicators, new clients, new money, clients putting that money to work, is exactly what we had hoped for and have seen for some years. So now it's sort of all coming together. Add to that the market tumult, as you said, since April, and it's been up and down quite a bit, including copper today. But
is there a point where too much volatility becomes too bad for your business?
Of course, and I think we wonder all the time, when is the fatigue going to set in? It hasn't happened yet, because things have been on I would say, a steadily improving trend, both in terms of economic outlook. Obviously, there's debates. There's debates within the Fed, as we saw yesterday. But the uncertainty certainly leads to a little bit of delay in terms of decision making. So we look at some of our clients, whether they're Western or developed economy companies or companies operating throughout the emerging markets, they're just holding off on their investments to see where's it going to come out. But the fact is that the tariff noise, at least for the time being, is settling out. A lot of detail yet to be worked through. But nevertheless, I think confidence is building, investments are coming. It's reflected through to our business.
Well, if we break down that uncertainty, what worries you more, US tariffs or falling rates?
I mean, falling rates, all else equal, is a challenging thing for a bank in the short term. But we also know that simulates investments. And fundamentally, our bank is about investing and trade, right? That's whether it's at the individual level or the corporate level. So falling interest rates would certainly support the investment decisions that our clients are making. And it would impact our NII, net interest income, on the margin. So I won't say we're indifferent, because in the short term, certainly that period of zero interest rates was very difficult for us, as it was for every bank. But that's not where we're going. A little bit of topping and tailing. I think we're actually in the sweet spot right now.
And when you look at the share price, I'm not going to use the C word that you once used to describe it, but you're up more than 30% this year. It's past the level when you took the job and then some. Are you happy with this now?
Yeah, I'm happy with the progress. I'm happy with the progress for sure. I also look at our bank and say this is a bank that's growing its operating earnings in reasonably substantial double digits. We've been growing at 20 or 25% for some time now in terms of our underlying earnings. And I think that can go for some time based on the investments that we've been making for years. That should come through to our stock price over time. So I don't get too obsessively focused on the stock price day to day. But of course, I'm happier at 1370 or wherever we are. Rather than 6 when I used a bad word to describe our share price.
But how much higher do you think it can go?
I think by most relative measures, we're relatively cheap. So compared to other Asian banks, for example, or other even European banks in some cases. So I think we can go. We have
what would be fair?
I'm never going to predict a stock price. Look, what I focus on is growing our income, our customer satisfaction, managing expenses, keeping risk under control, and returning excess capital to shareholders. That's what we focus on. The stock market is going to take care of the rest.
I want to talk about how Standard Chartered differs to some of your big competitors, right? We had HSBC earnings yesterday. You're starting to plot a kind of different course to some of them. I think about the return to office, for example, HSBC ordering MDs back. Are you seeing your option to hybrid work as, a really valuable way to attract talent over your competitors?
It absolutely is. But here's the secret. Our MDs want to come to the office, right? They come to the office because they collaborate, they manage their people, they lead teams. But if they need the flexibility, they can get it from us. Now, you've got to have an agreement with your manager. I mean, you don't get to set your own schedule. So there's a discussion. But no, I think we find... Look, we work with adults. The adults can have an adult conversation with other adults and decide how they're going to best manage their team, how they're going to collaborate. It's working for us. How other companies make that work, everybody's got their own recipe.
Are you working hybrid, Bill?
Yeah, here I am. It's at 6:30 in the morning. I'm sitting in your studio. I'm not in the office slaving away behind my laptop. I work from home from time to time. If I come in from an overnight flight someplace, or if I have a meeting in the West End, I live in West London. Yeah, sure.
You've got to lead from the top.
I also, my agreement with my boss is that I come to the office 4 days a week. I think I probably average a little bit higher than that, but.
We all have a master. Look, you're also different from your competitors in terms of the fact that you're super bullish when it comes to crypto. $200,000 is your target. Do you think that that's an area where there's an advantage in particular for Standard Chartered?
So we are super bullish as a bank on digital assets. And we're super bullish on blockchain settlements, whether it's in payments or securities or anything else. Crypto, the $200,000 Bitcoin forecast, that's our research team. Now, he's been pretty close to right consistently. So I definitely don't contradict Jeff. But from our perspective, we see a structural movement towards blockchain-based settlements, of which it starts most substantially today with cryptocurrencies. But when that cryptocurrency technology ports into traditional finance, which is what's happening now with stablecoins and the like, we are there with the infrastructure that's ready to receive. And we're going to take market share from people who haven't been making those investments, in our case, for 7 years.
Well, yeah, is the plan basically to become the biggest mainstream trader in crypto assets?
Digital assets, right. So cryptocurrencies is one part today. It's big and it's growing. But stablecoins, tokenized bank deposits, eventually central bank digital currencies as they arrive, if they arrive, all of those things will be mediums of exchange for what today is traditional finance, which tomorrow will be a new mechanism for payments and settlement. And we are building that infrastructure. We have it through various ventures that we've set up. We're the most substantial institutional grade dealer in digital assets, and our institutional customers really value that. At some point, our retail customers will really value that as well.
There's a similarity to HSBC as well. You're both in cost-cutting drives. Yours is, of course, called Fit for Growth, this efficiency plan. It's set to peak this year. Yeah. How important is that to you right now, and how difficult is it proving?
So Fit for Growth for us really is a transformation program. And yes, out of the back end of transformation, we'll save $1.5 billion of operating expenses, which is material for us. And we're investing significantly to simplify everything that we do, mostly through technology, digitize, et cetera. So that transformation is very important. The cost-cutting element is kind of what we've been doing for my entire 10 years in the bank. You know, with $300, $400, $500 million per year of efficiency, which we then invest back into the business. So our overall expenses, I hate to say it, continue to grow up. The key for us is that they go up a lot slower than our income, and that's what we've been doing.
And finally, Bill, you just marked a decade as CEO of Standard Chartered. You had a lovely interview with our colleague Francine Lacroix about this. I know that you're a thoughtful man. You told her that you'd have to be thrown out of Standard Chartered. Is there a particular milestone that you want to reach before you go?
No, not particularly. I'm pretty sure that whatever I leave behind, the next guy or woman is going to be able to grow really nicely from there. But I would like to do everything I can between now and then, whenever that then is, to set the place up for continuous growth. We've got a clear set of financial plans that go through the end of next year. Very keen to deliver that. We're very much on track. We've got a new chairman, Maria Ramos, who's been fabulous. It's her call on how we manage these succession things.
All right, well, it's lovely to have you back. Bill Winters, CEO of Standard Chartered, celebrating a decade in the job. Nice to have you, Jill.
Thank you.
Coming up on the programme, Schneider Electric reports an earnings beat. I'll be speaking to the CEO of that French industrial technology giant. Coming up next, this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's continue with earnings, but we turn now to the French industrial technology giant Schneider Electric. It's reported adjusted EBITDA for the first half year ahead of estimates, and I'm pleased to say we're now joined by Olivier Blum, who is CEO of Schneider Electric. Olivier, good morning. Thank you for joining us. Let's walk through these results, shall we? You've got record revenues and profit for a first half. Just talk us through how well positioned this means you are in such a climate of uncertainty.
Yeah, for sure. Good morning, and thanks for having me. You know, Schneider Electric, it's simple. You know, we claim to be an energy tech company, and we develop technology to help our customer to electrify, digitize, and automate. At the end of the day, what we want is to make our customer more efficient, you know, more sustainable. And we have a position today that helps us between our position in data center, in infrastructure, power grid, and so on and so forth, to be ideally positioned if you want to help our customer to electrify and save energy. So, of course, despite the uncertainty of the environment, we have a pretty good positioning, and also on the geographical side, because we have a fairly balanced positioning between what we do in North America, but also in Asia, between China and India. So, all in all, we are still in a very favorable environment, and we are very pleased with record sales in H1.
So you've reaffirmed your full-year target. To be clear, does that mean that you expect to see continued demand from data centers for equipment?
Yes, absolutely. Whether I look, by the way, in the short term for the next 6 months, and of course the backlog gives us a good indication that we can deliver our end-of-year guidance. But also if I look at beyond 2025, the demand in data center, even if it's changing sometime and it changes all the time, you know, the mix between customer, geography, more with hyperscaler, more with colo, but all together, the demand continues to be very, very robust, at least for the next 2 to 3 years.
And when you look at the tariff deal agreed between the US and the EU, is 15% a good deal?
Look, I cannot comment if it's a good deal overall. What I can tell you, at least for Schneider Electric, it's a very, very minimum impact for us. I would say beyond Europe, the tariff is creating a lot of uncertainty, of course, in the market. And more than uncertainty, you know, it has to be managed between us, our distributor, the end user. All of us have to protect our margin also at the end of the day. So I would say it creates a lot of distraction in any kind of industry, but we are not too much concerned. It will be immaterial to Schneider what's happening right now in Europe.
Well, just spell out to me what that means. Minimum impact. What sort of impact is it in terms of trade flow, in terms of investments in Europe, in terms of, as you say, the competitiveness of your industrial clients?
Yep. You know, for Schneider Electric, and we started a long time ago, and even before COVID, our strategy has been always, you know, to manufacture, to buy 90% of what we sell in every region. So 90% of what we buy and sell in North America come from North America, and so on and so forth for Asia, Middle East, and Europe. So we are not too much dependent. Of course, we have a bit of an exposure. You know, we have always a couple of imports from Europe to US or from Asia to US, but actually we don't have a lot coming from Europe to the US. So when I say it's immaterial, it's maybe a few million euro at the end of the day for the second part of the year. But we always said in our communication that since the tariff have started, we will have a couple of 100 million for the full year that will compensate through margin, through pricing, and productivity. And I stick to that number because, you know, with all the latest announcements, it's more or less few million, but at the end of the day, this couple of 100 million remain the same for us in terms of impact for the full year.
Well, in terms of the indirect impact through FX, the euro up over 10% this year against the dollar. Could that help your business when it comes to acquisitions in the US over the coming months?
Well, it could, you know, as you know, the Forex is always something which is very volatile. We communicated that there is a bit of impact for us, definitely in H1. We see some stability. Of course, that creates always opportunity when it comes to M&A. You know, we are always keen at Schneider Electric at looking at option when it makes sense strategically and when it makes sense from a price standpoint.
And of course, it's not just geopolitical uncertainty. There's also the risk of domestic political uncertainty in France later on this year. We could see government collapse before year end. How worried are you about that?
Well, look, first of all, you know, France is extremely small for Schneider Electric today, so we have a little exposure. I remind you that our first country in the world is US, the second one is China, the third one being India, and France will come really much after that. We are always looking what happened in France in other countries. Actually, the positive news in France, I don't know if you're aware, but there is a lot of investment in data centers, so the pipe is very healthy, and we see that, frankly speaking, as a very good opportunity for Schneider Electric, which end-to-end give us really a good opportunity for growth in the coming cycle. Now, of course, like anybody else, we would expect much more stability in the politics in Europe, in France. We hope it will be the same in Germany. That will be a good booster for the business.
And just finally, Olivier, I want to come back to M&A because you've just bought the remaining stake in your Indian venture. What's next?
Well, look, let's start to, enjoy what we have done in India. Number one, absolutely, we mentioned yesterday that we bought the 35% remaining stake. That makes Schneider Electric in India the third largest country of Schneider. As I said, it's very important. I was sent myself to India in Jan 28, 2008. It was 100 million. Today, last year, it was 2.5 billion for Schneider. And beyond India, which is really a double-digit growth opportunity, India is a fourth hub of Schneider on which we are going to capitalize in R&D and supply chain. Now, what's next? As I said, we keep on building, the next phase of Schneider Electric. We have to digest the acquisition of India. We announced also in H1 the acquisition of, we closed actually the acquisition of Motivair, liquid cooling, which is extremely successful so far, above our business case. Let's take time to digest, but of course, we are always preparing the next phase.
Always a pleasure, Olivier. Thanks so much for making time for us. Olivier Blum, CEO of Schneider Electric. We thank you. Well, let's stay in France. Airbus reporting a bigger than expected cash outflow as a shortage of engines hampered its ability to deliver aircraft. CEO Guillaume Faury has been speaking to Bloomberg.
What we see in the first half of the year is a number of delivery that is at 306. But we have also to have in mind that we have 60 aircraft sitting on the ground, fully finished, but with engines missing. We call them gliders. So if you look at what we've been able to produce, including the gliders, actually we are mostly on track with what we expected to do in the first half. So we count on engine makers, namely CFM and to a smaller extent Pratt, to recover on their engine deliveries to Airbus, so we can be back on track with a number of deliveries. So actually, the negative free cash flow that we have recorded for the first half reflects mainly those missing deliveries and engine missing, leading to aircraft on the ground. Overall, we have confirmed our guidance because we believe we will get those engines and we'll be back to where we need to be.
Are the delays in getting those engines, is that related to labor issues or is that more for parts and just some holdups in the supply chain?
Well, that's more the latter. Actually, these are more short-term issues that were generated in the first half of the year. When we look at the CFM situation, GE faced industrial difficulties in the beginning of the year. They delivered their cores, the hot section of the engines, late to the other partner, which is Safran. And then Safran faced a strike, a 7-week strike that impacted very significantly their ability to deliver on time.
The Airbus CEO speaking to Bloomberg's Romain Bostic. Live from London, this is Bloomberg.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Despite elevated uncertainty, the economy is in a solid position. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get.
The Fed Chair Jerome Powell speaking after that decision to hold rates yesterday. But look, there were two dissenters for the first time since 1993, Michelle Bowman and Christopher Waller as well. So you can see that here, but flip the board over because actually you saw traders paring bets off the back of this decision. So actually traders reading into the commentary from Chair Powell, we'll see the analysis of it in just a moment, as not so dovish. This is what our analysis at Bloomberg Intelligence has said. So you had those two dissenters, but of course we also are looking at the tech earnings story. That's what's dominating the equity picture. We've just had Microsoft and Meta yesterday, beats for both. That is what is powering the futures picture, and you can see what we've had in the aftermarket moves on both of those, up more than 11% when it comes to Meta. So driving Nasdaq futures this morning, but futures higher on both sides of the Atlantic. Not so for FTSE 100 futures, it has to be said, but the optimism spreading across the pond. Now, we look ahead to Apple and Amazon later on. Apple and Amazon later on today. We'll be covering those in the next few hours, but Bloomberg Terminal users can access these charts and more used throughout the show on GTV Go on your Bloomberg Terminal. It is a busy day of earnings. We've had plenty already, but there's plenty more to come. We're going to have interviews with the CEOs of Shell and Anglo American, so you're not going to want to miss those. Anna Critty and Guy will take you all the way to the opening trade. That show coming up next. This is Bloomberg.